Welcome to ForexTV.com. It's Wednesday, January 30th. I'm Remy Hokie for your New York Forex Market Buzz. In afternoon trade, as of 12:50 p.m. Eastern Time, Euro dollar is at 1.4787. Sterling dollar is at 1.9868, while dollar yen is trading around 107.28. The market awaits the FOMC rate announcement due out at 2:15 p.m. Eastern Time. And taking a look at today's U.S. data releases, Q4 advanced GDP came in sharply lower than expected. The Commerce Department reported that GDP rose at a seasonally adjusted 0.6% annual rate from the 4.9% in Q3. For the entire year of 2007, GDP grew 2.2%, the slowest growth since 2002. And according to today's ADP report, the private sector added 130,000 jobs in January. The Labor Department will release non-farm payrolls data Friday morning at 8:30 a.m. Eastern Time. Joining me now is Rhonda Staskow from Thomson Financial. Good afternoon, Rhonda.
Good afternoon, Remy.
Thanks for joining us today. Well, it's finally Fed Day, and in a little over an hour, the FOMC will announce their rate decision. The markets will be reacting to the decision, so while we are at a brief standstill, dollar-yen has barely moved in the past hour and a half. But post-FOMC, if you could tell us what we should be watching for the yen and the yen crosses.
Well, it's going to be a very interesting day, least of which is many in the market are expecting reactionary moves to price out what the Fed already does. In other words, a lot of profit taking after the Fed actually moves. The consensus seems to be that if they move 50 basis points, that the stock market will go up, and that will, of course, foster carry trade demand, which is sort of bullish for dollar-yen. But a 50 basis point rate cut, of course, is going to shrink the U.S. yield spread over Japan quite dramatically. And so that ends up being dollar-yen negative, and you sell into it. The other thing is many traders don't think a stock market rally will last on a 50 basis point rate cut. And as a result, there'll be some profit taking on the yen crosses and also on dollar-yen afterwards. And I think it's a secondary reaction that the market will be more focused on. Now, if they do 25 basis points, I think that will hurt the stock market, but quite frankly, I think that will be supportive of the dollar, since only a minority are expecting 25 basis points from the Fed, and that could actually be a major shift for the dollar, especially after having the stimulus package looking to be passed soon and to help stimulate the economy.
Okay, you've given us your expectations for the decision, so let's move on to the euro dollar. The euro has not rallied to record highs against the dollar recently, but from a both fundamental and technical perspective, if you could give us your short-term forecast for the pair.
Well, I want to look over a forecast over a little bit longer. Quite frankly, like if they do 50 basis points, I think you could see the euro attempt to go higher. But as we've seen in recent weeks, the euro has failed to be able to rally above 150, and I think that's very critical for a number of reasons. One is that custody holdings, which are foreign central banks and national sovereign accounts holdings of U.S. Treasuries, have risen $45 billion in just the last 2 weeks, showing a move to the dollar from the foreign central banks. Two, the IMM speculative holdings of euros have dropped to the lowest since 2006. I think the demand for the euro is falling. And so if there is a knee-jerk gain in the euro, let's say to the high 148s after the Fed move, I think it will be an opportunity to sell, and I still see the euro drifting down to 143, 144 in the weeks ahead.
Well, you've given us your take on the yen as well as the euro against the dollar, so let's shift our focus over to the dollar block currencies against the U.S. dollar. What will determine price action for the so-called commodity currencies against the U.S. currency?
Well, there is a lot of advice coming out right now from fund managers and other sources saying that because of the Fed rate cut, that the dollar block or high-yield currencies, including Brazil, including Aussie, and including the Kiwi dollar, will go up as a result of these rate cuts. And so you should buy these currencies. But even though you're looking at the spreads, for instance, on Kiwi widening to 15-year highs, Kiwi is still off the highs that we saw last year. With the growth forecast for the globe, which is starting to deteriorate, dramatically, given the IMF cut in forecasts we saw for world growth yesterday. I think that's really a negative for the dollar block currencies and for Aussie yen, Kiwi yen crosses, and so-called carry trades. So even though there may be a knee-jerk rally on these currencies, I still think the prospects for these currencies longer term won't be as good. Now, for the Aussie, there still is a risk to trigger some stops today above 89.20, but I still think we will see sellers into any rallies towards 90. So I think 90 will probably cap in the next 24, 48 hours, and we'll see the Australian dollar move back towards 85 in the coming weeks. And I think the same scenario holds for the Kiwi dollar, that there still are risks right